Hey, future financial powerhouse, welcome back to the channel. The $50,000 mistake you're about to make. Are you a young crypto trader, maybe a work-from-home professional, grinding to make your money work harder? Then listen up, because the difference between a life-changing portfolio and a devastating loss often comes down to just a handful of avoidable mistakes. I'm talking about the errors that have cost traders tens of thousands of dollars, the mistakes you don't even know you're making right now. Today we're ripping the band-aid off and looking at the 6 top categories of crypto trading mistakes that are silently killing your profits. Stick around, because by the end of this video, you'll have an actionable roadmap to trade smarter, sleep better, and stop leaving money on the table. 3 core benefits you'll get from this video. 1. Stop the bleeding. You'll learn how to identify and plug the leaks in your strategy, turning those red days into green ones. 2. Trade with confidence. We'll demystify complex concepts, giving you the knowledge to confidently say no to bad trades and yes to solid opportunities. 3. Future-proof. Your portfolio? Discover the essential security and management habits that protect your hard-earned assets from hackers and scams. Ready to level up your trading game? Let's dive into category number 1. 1. Knowledge and education deficits. This is the foundation. If you don't know the basics, you're building a house on sand. Don't know the basics. You must understand core concepts like blockchain, the difference between circulating supply and total supply, and how your wallet and private keys actually work. If you don't understand these, you're not trading, you're gambling. Are a math noob. This one is crucial for risk management. A 50% drop in price requires a 100% recovery just to break even. Understand the math, or you'll get liquidated by the market. Think cryptocurrencies are shares. They are not stocks. Most don't grant you ownership or pay dividends unless they're a specific security token. Stop applying stock market logic to a completely different asset class. Don't understand tax implications. For many jurisdictions, every crypto-to-crypto trade is a taxable event, a realized gain or loss. Ignoring this is a mistake that can catch up to you years later. Don't get stung by the tax man. 2. Poor trading and risk management habits. If category 1 is about knowledge, this one is about discipline. This is where most traders fail. Invest life savings. The oldest and most important rule in crypto. Never invest more than you can afford to lose. Seriously, take a portion you'd be okay lighting on fire and start there. Overtrade and ignore fees. Excessive trading dramatically increases your transaction fees, and those little charges add up fast. They can literally kill your profits. You're often better off making fewer, more thoughtful trades. Don't have a plan. You need an exit strategy before you enter a trade. Set a target price for profits and a stop-loss price for cutting losses. Don't take profits. Don't cut losses. Gains are just numbers on a screen until you sell. Be disciplined and take profits according to your plan. Likewise, if you no longer believe in a coin, cut your losses. Don't let stubbornness turn a small loss into a catastrophic one. Diversification traps. Don't over-diversify. It's impossible to track 50 coins. Keep it manageable, maybe a maximum of 10 coins, so you can keep up with the news and price action for each. 1. Emotional and psychological errors. The market is designed to mess with your head. Don't let it. FOMO, fear of missing out. This is the killer. Buying an asset purely because it's pumping or there's some hyped announcement is buying out of greed, not logic. You're almost always buying the top. Panic, sell, and fall for FUD. FUD, fear, uncertainty, and doubt, is often spread by whales or shillers who want to drive the price down so they can buy in lower. Don't let negative news or a small price dip scare you into selling at a loss. Buy high. When a coin is near its all-time high, your probability of a short-term correction is much higher. Be patient. The market rewards those who wait. Are emotionally attached. Trading must be based on logic and data. It's a transaction, not a relationship. Let go of a lost project instead of holding on to an irrational belief it will magically recover. Number 4. Research, information, and liquidity traps. You've heard it before, but are you doing it right? Don't do your own research. DYOR. Don't buy on impulse or hype. Research the mission, the team, and the tokenomics before you invest a single dollar. Chase cheap coins. Stop looking at the price per coin. A 0.01 coin with a massive supply is not cheaper than a $50 coin with a low supply. Focus on a coin's market capitalization for a true understanding of growth potential. Follow shills and crowds. Many influencers are compensated to promote coins. When everyone is talking about a coin, it might actually be time to sell, not buy. Buy the news. The professional mantra is buy the rumor, sell the news. By the time a major announcement hits mainstream media, the smart money has already positioned itself. You're likely too late. Enter positions you can't exit. Low liquidity means low trade volume. If you buy a coin with low liquidity, you might find it difficult or even impossible to sell quickly when you need to. Category 5. Security and management mistakes. This category is about protecting what you've earned. Don't let hackers or scams take it all away. Don't use 2FA. Two-factor authentication is non-negotiable. Enable it on every exchange and email account you use for crypto. Leave coins on exchanges. Exchanges are massive targets for hackers. The mantra is, not your keys, not your coins. For any significant holding, get your assets off the exchange and into your own wallet. Don't own a hardware wallet. If you have more than about $500 invested, get a hardware wallet. They're disconnected from the internet and are the gold standard for security. Fall for scams. Double-check URLs. Watch out for subtle misspellings like Coinbase.com instead of Coinbase.com. And please, avoid any offer that promises easy money or suspiciously high guaranteed returns. It's a trap. 6. Missing opportunities. It's not just about avoiding losses, it's about maximizing gains. Ignore airdrops. Airdrops are often free money used by projects for marketing. Minimal effort, big payoff. Don't just hold your assets. Use platforms to stake proof-of-stake coins or lending platforms to earn interest. Make your money work while you wait. The catch? There you have it. The 6 categories of crypto trading mistakes. Now that you know the pitfalls, you have the power to avoid them. Remember, trading isn't about being right all the time. It's about making fewer mistakes than the next person. If this video helped you avoid even one of these costly mistakes, do me a huge favor. 1. Hit that like button and subscribe to the channel. We review new, actionable trading guides to help you win. 2. If you're serious about building a robust long-term portfolio, I've linked to the Ultimate Crypto Portfolio AI Trading class in the description below. It's the exact learning curve to manage risk, track diversification, and never miss a profit-taking opportunity. Go check it out. Keep trading smart, stay disciplined, and I'll see you in the next video.